Hey there guys, and welcome back to another NCA Accounting Help video. Today we're going to do a exam walkthrough of Accounting 2.4 or 91177. So the official thing for this standard, the official definition for the standard is interpreting accounting information for entities that operate accounting subsystems. So that's quite a confusing definition, but the gist of it is that we're looking at some financial information and we need to explain the financial information, reason and give reasons on why it might be occurring, and then provide some advice to the business. If you haven't already, take a look at my original video looking at the concepts and kind of the fundamentals of this standard, because that's definitely going to come up time and time again in this walkthrough. Yeah, and also have the resource booklet in front of you. Definitely helps. I'm going to reference to the resource booklet throughout this, so just having it in front of you will also help a lot, or just reading it through before you watch the video. Yeah, we'll get into it. So starting off here, I'll just read through the question. So this is for Strut Your Stuff's financial statement. So we'll have a look through. So percentage change in sales, 2023 was 6.1% plus. 2024 was plus 5.2%. The total expense percentage was 43.2%, and in 2024 was 48.9%. So that's quite a large increase for expenses. And then the profit for the year in 2023 was 5.6%, and in 2024 was a minus 1.5%, which actually means that they made a loss that year. So just looking at the question here, so justify how the increase in expenses has contributed to the trend in Strut Your Stuff's profit percentage from 2023 to 2024. In your answer, explain the meaning of the total expense percentage of 48.9% in 2024, one possible reason for the trend, other than the increase in finance costs, and the link between the trend in total expense percentage and the profit for the year percentage from 2023 to 2024. Okay, so when we get a question like this, it's a good idea to just go through and individually answer each bullet point instead of just trying to answer the whole question. It makes it a bit easier and a bit more straightforward. So we'll get on into it. So if we just look at the first bullet point here, it says the meaning of the total expense percentage of 48.9%. So we'll start off by just explaining that. So NCA quite likes you to just give a very simple example that anyone can understand. So the most simple example is $1. So for every $1 of sales, X number of cents is spent on, etc. So we'll get into that here. So I would say the total expense percentage, percentage of 48.9% in 2024 means that SYS has spent 48.9 cents on all expenses, and then just that's all three expenses. So we'll just give the three examples. So administrative, distribution, and finance. For every $1 of sales. So just looking at that, that is quite a high figure. Most businesses is a bit lower, and 48.9, it's an increase from 43. So it means their expenses have increased by quite a lot, which will definitely come up in the next question. So if we just look at the next question, it is one possible reason for the trend in total expense percentage from 2023 to 2024, other than the increase in finance costs. So, in the information booklet, it tells us that there have been an increase in missing and damaged stock, which has increased their insurance. So insurance is an expense for Strut Your Stuff, so that would obviously increase their expense percentage. So for this second bullet point, I'm going to go with that. And there is a few other options you could do here. You could talk about gas prices increasing and a few other things. But just for this, we're going to go with the increase in insurance premiums. So what we want to do is we want to start off by writing, explaining all out the data that they've given us. So we'd start off by saying, so one reason for the increase in total expense percentage from, and then in 2023 it was 43.2%. In 2023 to 48.9% in 2024. So this increase, one reason, so one reason for the increase in total expense percentage from 42.3% in 2023 to 48.9% in 2024 could be the increase in insurance claims in recent years. I'll just put this on new line for you guys. In recent years, the increase in claims would increase insurance premiums. And just for those of you who don't know, so an insurance premium is just essentially how much people pay for insurance, which means expenses would increase. Just chuck that on new line for you guys, sorry. So just, you really want to spell it out and just make it super straightforward. So maybe here, so I'd say this, increase in insurance costs would increase administrative and distribution costs, therefore increasing total expenses. Yeah, so just that there is kind of what they're looking for those first two bullet points. And then just for the final bullet point, they say the link between the trends in total expense percentage and the profit for the year percentage from 2023 to 2024. So, as insurance doesn't, so an increase in insurance wouldn't increase their sales, for example. So it's they're not related to each other. There's no relationship between the two of them. If you had decided to go for increase in gas prices, similarly, there's not a relationship between the two. So what they kind of want here is nothing complicated, just a simple sentence explaining it. So you could say something like, as insurance costs don't increase, don't have a relationship with, pardon me, don't have a relationship, sorry, maybe I'll say a direct relationship with sales. When they increase and sales stay constant, there will be a decrease in net profit and profit percentage. Yeah, so that's really all you need just for that first question. So it does look like there's quite a lot to write, but it's not too bad. So the key is just going through each one of those bullet points and then answering them individually and just kind of thinking it through, because it's not too complicated. It kind of sounds like they might be trying to trick you sometimes, but it's really not that bad. So that first bullet point's an achieved mark, second bullet point merit, and then that third one is an excellent. So if you've answered that question right, you're already sitting at an M5, so, and you do nothing else in the second part of the question. So it's definitely good to try answer all the questions. And yeah, all right, we'll move on to the next one now. So this here is a bit harder. So it's looking at some kind of more complex concepts in accounting, and there's a lot of writing they want you to do. But trust me, it's not that bad. So here they say discuss the relationship between Strut Your Stuff's equity ratio and finance cost percentage. In your answer, state and explain the reason for the trend in finance cost percentage increasing from 0.9% in 2023 to 1.8% in 2024. Explain how this reason has contributed to the trend in equity ratio and include dollar amounts. So yeah guys, so definitely if you haven't already, I know I'll say this a few times, but do watch my video. I kind of explain what these concepts mean if you're kind of drawing a bit of a blank right now. If you have watched the video or you've kind of studied them a bit before, that's okay, and we'll get into it. So we'll start off with that first bullet point, which says state and explain the reason for the trend in finance cost percentage from 0.9 to 1.8. So if we look at the resource booklet, it says that they've taken out an increase in debt. So they've increased their debt, they've taken out more of a loan. The side effect of that is going to be that your finance costs, which is primarily your interest on loans, is going to increase. So it's increased from 2,000 to 4,200. So yeah, so we'll get into that. So so just for that first bullet point, I'd say, so the finance cost percentage has increased from 0.9% in 2023 to 1.8% in 2024. Because and always remember guys to bring the figures, the exact numbers in from your resource booklet, because sometimes you'll actually be marked down if you don't have the exact figures. So because the $17,000 increase in loan, and then I'll just put in brackets what the actual figures were, so 30,000. I'll chuck that on the next line. 30,000 to 47,000, so 17,000 increase. So yeah, it does take a bit more time guys, but it's definitely worth putting those extra figures in. So from 30,000 to 47,000. Has increased interest on loan to be paid as shown, and then just keep giving those figures again guys. I know it gets a bit repetitive, but you've really got to keep doing it. Find it as shown by the increase in finance costs from 2,000 to 4,200. So there was also an increase in sales, and we do want to reference this as well, because if, for example, sales increased by times 10 and finance costs only increased by double, finance cost percentage would actually decrease. So we do want to reference that as well. So we just say even with the increase in sales, finance increase percent to 1.8%. Sorry, 1.8%. As the increase in interest on loan was proportionately greater, resulting in an increase in finance cost percentage. So what do I mean when I say it was proportionally greater? Awful spelling, but proportionately greater. So when I say that, I'm kind of referring to the fact that the finance cost did more than double, whereas sales only had a 5% increase. So they're not looking for this kind of second part of that question. They're not really looking you to get into the more technical side of it. They just really want to kind of show that you've got a bit of thinking about the more advanced stuff. Okay, so going into the second bullet point, explain how this reason has contributed to the trend in equity ratio. So if we think back to the equity ratio, it is our current assets to our current liabilities. So an equity ratio of 0.49 means that there is 0.49 there's 49 cents of assets for every $1 of liabilities. And in 2024, that means there is 39 cents for every $1 of liabilities. So the reason for the finance cost percentage increasing was because we took out a greater loan. So by taking out a greater loan, we've increased our current liabilities. So that's kind of what they're looking for us to say. So what we'd kind of maybe say is, so the increase in loan from 30,000 to 47,000 in SYS, short for Strut Your Stuff loan. And then again, they really want to see here is us referencing back to the booklet. So if you have the opportunity to reference back to the booklet, you really should. So the reason they got out the loan in the booklet was to pay off the security system, to pay for a new security system, and I think it was also to pay off their overdraft. Sorry, hold on. Okay, my apologies. I'll just delete that actually. So equity ratio is not that at all. Equity ratio is focusing on how much of the business have been funded, how much of the business's total assets have been funded by the owner. So my apologies for that. I was getting confused with the current ratio. So we can all make mistakes, definitely. So the equity ratio is focusing on how much of the business's total assets, so that includes stuff like, your bank account, your security system, stuff like that, have been funded by the owner of the business, and how much have been funded by debt. So when they say the equity ratio is 0.49 to 1, this means that the owners funded 49% of all of Strut Your Stuff's assets in 2023 and 39 cents in 2024. So obviously there was a large decrease. So what would the reason for that decrease is because they took out that $17,000 loan. That also led to the increase in finance cost percentage. So that's kind of what they're looking for here for this next part. So sorry about that, confusing you guys there. So I'd say the increase in debt from 30,000 to 47,000 for SYS, just abbreviate it, to purchase, and we want to give an example again, so to purchase the new security system, pay their overdraft, was all funded by an increase in debt and not from the owner. So this increased total assets, because this does confuse a few people, but even though we're taking out debt to buy these new things, their new security system, and to pay their overdraft, they're still getting cash in the bank, which is an asset, which they're spending in this example by another asset, the security system. So that it kind of comes back again to what I was talking about in that very first video, which is the double entry system. So it's increasing the liabilities, but also the assets at the same time. So we'll just say this increased total assets, and yeah, so just referencing back to the booklet, total assets from I think it's 8740 2023 to 92 720 in 2024. Sorry. Without any changes in equity from the owner. Yeah, so that's kind of caused the amount of assets funded by debt to increase. So this has caused the amount of assets funded by debt to increase. While assets the owner do stay the same. Stay constant, leading to the decrease in equity ratio from 49 to 1, sorry, 0.49 to 1. In 2023 to 0.39 to 1 in 2024. Yeah, that's all they're looking for. So if you'd kind of answered all of that stuff, you'd be looking at an E8 for question 1. I'm just looking at the answer sheet now. Yeah, so in the answer sheet, one of the really main things that they're looking for is you integrating numbers into your report. So if you kind of look at my report here, I've got a lot of numbers there. That's really one thing that they really want to see a lot of. Apart from that, just really reading the question through, and yeah, all right, we'll go on to question 2 now.